buy the product even in a sale period, so they will entertain the refund also, right? For example, so in most of the store, when you went for a shopping in a sale period, so they will not entertain any exchange or refund, right? But Stenmex, as far as the behavior of the owner, right? For example, in the last class, we have taken two examples. The company is a manufacturing company, and they are emitting some carbon emissions, right? And there is a law which says that if you will emit carbon exceeding a certain threshold, you have to pay such a penalty, or let's say you have to incur some expenses for the environmental cleanup, right? In this case, whenever this carbon emission will happen, it will result into a legal obligation, right? The second example is there is no legislation for environmental cleanup, but but uh, there is a policy which has been published on the website of the company, and this policy says that we are not we are a environment friendly company. We are not impacting the environment and environment in the negative way, right? So if there is any impact or if there is any carbon emission which is detrimental to environment, we will insure and we will incur such cost for plantation of trees, for setting purifiers. So there is a published policies on the website of the company. There is no legal regulation. In this case, due to the published policy, this will become a constructive obligation. So friends, for recognition of provision, there should be a present obligation arising out of past event, and the obligation can be estimated reliably, the amount can be measured reliably, okay, and there is a probability of outflow of economic resources. So whenever this obligation will be settled, there should be outflow of resources of the company. So outflow is probable, amount is measurable, and there should be a present obligation, right? Is it clear? Good. So guys, I hope I'm audible, because one of the participant is saying video is got stuck. I hope my video is running fine. Mr. Nisar, can you please confirm on the chat box? Video and audio both are fine? Okay. So probably the students who are watching this video on a live basis, so they have to check their internet connection, because I have just got confirmed from ICI team that this video is running fine. Okay. Sairam, you need to check your connection, please. Yeah. So students, I'm just repeating or I'm just revising what we have discussed in the last class. Okay. So legal and constructive obligation we have discussed, and we have also done some case studies on this aspect, right? So friends, then we have discussed that what is meant by probable. So probable means more likely than not. Okay. More likely than not means there are more than 50% chances that yes, this provision will be incurred, this amount will be payable, right? Then we have discussed the meaning of contingent liability. What is meant by contingent liability? Contingent liability means a possible obligation arising out of a past event, right? A possible obligation arising out of a past event, but which can be confirmed. So this is not confirmed today. This will be confirmed, and this confirmation is depending upon the future circumstances. Okay. So possible obligation arising of past event, which is depending on the future circumstances, which is depending on the future, right? Happening or non happening of some future events. Present obligation arising out of a past event. Okay. So contingent liability is a present obligation also. Sir, if it is a present obligation arising out of a past event, then why provision is not there? Provision is not there because either it is not meeting the second condition or third condition. So it is present obligation arising out of a past event, but either outflow is not probable or outflow is not measurable, right? What is meant by contingent asset? Contingent assets are possible assets arising out of a past event. Again, the confirmation will happen depending on the future circumstances, right? Coming to the recognition and measurement, we have discussed that if your liability, I mean to say, it is virtually certain, more than 95% probability is there, then of course provision needs to be recognized. If it is probable also, so if there are more than 50% chances that yes, this outflow is probable, this outflow will happen, in that case the provision, the liability has to be recognized in the books of accounts. But if it is less than 50%, right, then provision is not required to be recognized, contingent liability is required to be disclosed. But if it is less than 5%, then you can say that the chances are remote. In that case nothing is required. For example, I will take a real life example here. You have filed your income tax return for your company, and you must have seen in case of a lot of clients also, because you all are CA final students, and I believe you guys have completed 2 years of articleship as well, right? So guys, there is a client, and client has filed an income tax return, right? So assessing officer, so that return was picked under scrutiny assessment, and assessing officer has assessing officer has disallowed some expenses. And then the client went to the higher authority, client went to commissioner appeals or tribunal, and in the tribunal they have won the case. Okay, in the next year, again this client has filed a return of income. Again the assessing officer again has disallowed the expenses. The client argued that, sir, last year also you have disallowed the same kind of expenses, and we went to commissioner appeals and tribunal, and it was confirmed and it was decided in our favor. Then why you are disallowing again the same expenses in this particular year? So assessing officer is saying, so I will disallow, you can again go to the higher authority and you can get it allowed, right, but I will disallow. So he's again disallowing. So friends, in this case, the client knows that, okay, this officer is not in a, this officer does not want to go by the last year judgment, right? Because of some targets, because of something, he is disallowing, as simple as that. But as a client, I know that, as a client, as a chartered accountant, I know that. So the chances of losing this case are remote. Why? Because it has already been decided in our favor in the last year. Okay, so even there is less than 5% chances that outflow will be made, right? That the settlement will result in any outflow. Okay, it is only mere of a time and procedural thing, that again I have to file this appeal in CIT appeal or ITAT, and then I will again win the case. So in this case, even the demand which have been raised by the assessing officer, even in this case, contingent liability is not required to be disclosed, right? It is not required to be disclosed. Is it clear? What about contingent asset? Contingent asset means if, for example, the company has filed a claim with the insurance company, right? And there are 95% this claim will be received. So it means it is virtually certain. It is virtually certain. Okay. So if it is virtually certain, then it is no more a contingent asset, then it will be an asset. So this asset needs to be recognized. Okay. The second one is probable. The contingent asset is probable, means there are more than 50% chances that this claim will be received, but it is less than 95% chances. In this case, it has to be disclosed as a contingent asset in the notes to accounts. But there are less than 50% chances that this claim will be received. In this case, nothing is required. Of course, asset will not be recognized, and this disclosure is also not required to be made, right? Then we have discussed the measurement part, and while discussing the measurement part, so we have to talk about the 4-5 aspect. First of all, provision, as the name suggests, provision is a liability of uncertain timing or amount. If something which is uncertain in terms of timing or amount, then of course you need to estimate the number, and this estimate has to be the best estimate. And in the last class we have discussed that this best estimate means you have to apply some expected value approach. You have to apply some expected value method. You have to apply some statistical method. And we have discussed that there are two kind of method: probability weighted approach, where there are multiple outcome of an event. Then you have to multiply the probability with the outcome, right? And then you have to arrive at a number. And when you have aggregated all the probability weighted outcomes, you will get the probability weighted outcome for that complete event by the probability weighted approach. And the second one is most likely approach. Most likely approach is like a binary approach, yes or no, right? So it is like there are 80% chances that yes, this will happen, 20% chances this will not happen. It means 80% chances is more than 50%. It means going by the most likely approach, the provision has to be made at 100%, right? So this will be used, most likely approach will be used when there are single outcome. When there are single outcome means either yes or no. When there are not a multiple outcome, there are not a huge population, right? So we have discussed a case study on this in the last class. So now coming to the second aspect, present value method, present value rule. Coming to the second aspect, right? So present value rule, in the last class we have also discussed a case study on asset retirement obligation for 50 years. And there I have also explained you that how this, this future dismantling cost will be, estimated, and how it has to be calculated at a present value, right? So again, taking an example, for example, the company has so the customer has filed a suit against the company, a legal suit against the company, right? And the company is expecting, so the counsels or advocates are saying that yes, the company will have to incur the liability for this. So it is a weak case, and company may have to pay money to the customer while settling the obligation, right? So now the thing is, the councils are saying that it will take around 2-3 years to get the verdict or to get the judgment of this particular case, right? Now they are saying that, but after 2-3 years you have to pay around 10 lakh rupees after 3 years. Now the question arises, so the amount which is payable in future when this judgment will come is 10 lakh rupees, right? But of course there is a past event, and there is a present obligation arising out of past events. Outflow is probable, outflow is measurable, because the legal counsel are saying, the advocates are saying that it is a weak case and we may have to incur a liability of rupees 10 lakh. Now the question arises, if I have to pay after 3 years 10 lakh rupees, do I need to create a provision of 10 lakh rupees as of now, or do I need to create a provision on the basis of present value, right? If I have to pay 10 lakh rupees after 3 years, so do I need to deposit 10 lakh rupees today in my bank account so that I can fund my liability of 10 lakh in 3 years? Or do I need to deposit something which is lesser than 10 lakh today so that it will become 10 lakh after 3 years? Of course, lesser than 10 lakh, right? Because there is an interest component also. So friends, in this case, standard says that where the time value of the money is material, sir, what is meant by this time value of money is material? It means more than 1 year, from the reporting date. If the company expects that yes, this provision has to be payable after 1 year, then the amount of the provision has to be discounted and measured at present value, right? So in this case, the amount has to be measured at present value, like in case of asset retirement obligation, right? Clear? And the discount rate should be a pre-tax rate, like we have discussed in Ind AS 36, impairment of assets. What is meant by pre-tax rate? For example, the discount rate is 10%, right? 10% discount rate means weighted average borrowing cost, right? Weighted average cost of capital, weighted average borrowing cost, incremental borrowing cost is 10%. And the company says that this provision will resulting into an expenditure, and expenditure is allowable in income tax. And let's say income tax rate is 30%. So it should not be 7%. You cannot say that 10% discount rate is there, 30% we will get the tax benefit. So net 7% is there. It is not the case. The discount rate will always be a pre-tax rate. The discount rate will be your interest rate, right? As it is. You are not required to give a tax benefit or tax impact or tax adjustment with the discount rate. So discount rate should be a pre-tax rate before tax rate, right? And the provision has to be discounted if the time value of money is material, means if the liability will incur after 1 year from the reporting date. Clear? Let's discuss this case study. The company has estimated that the settlement of a legal obligation will give rise to a gross cash outflow of INR 10 lakh rupees in 3 years time, right? So gross cash outflow of 10 lakh in 3 years time. So the time is 3 years. The outflow is 10 lakh rupees. The gross interest rate on a government bond maturing in 3 years time is 6%. And there is an interest rate given, there is a discount rate given for 3 years time is 6%, right? And this 10 lakh rupees outflow is after 3 years. So now we need to calculate the amount of provision to be provided. Tell me what should be the amount of provision. So let me go into the Excel file. Please confirm if my Excel file is visible. Case study on present value calculation. Amount payable after 3 years. How much? How much amount is there which is payable after 3 years? 10 lakh. Amount payable after 3 years. What is the discount rate? Discount rate is 6%. So how to calculate the provision? Please tell me how to calculate the provision. Tell me what are the accounting entries and how to calculate the provision. Yeah. Sairam, Jay, Srinidhi, Utkarsh, Megha. Srinidhi is saying provision is to be provided at 488,39619. So in this case, first of all, I have to calculate my present value factor. Okay. Present value factor. So present value factor at the end of, so this has to be payable after 3 years, right? So present value factor on first, second and third year. On the first year, what is the present value factor? 1 divided by 1.06, right? Second year, it is again divided by 1.06. Again, it has to be divided by 1.06. So what is the present value factor for third year? The present value factor for third year is 0.839619. Okay. So in this case, present value will be present value of provision is equal to 10 lakh multiply by 0.839619. 839619 is the present value factor. Is the present value, right? So what will be the accounting entry? The accounting entry will be, what will be the accounting entry? Tell me what will be the accounting entry? Provision for legal expenses. Provision for legal expenses. Expenses. Debit. Provision for legal expenses. Debit. Right. To provision. To provision. Liability. So the first one is expenses. The second one is liability. Right. And this has to be credited. This has to be credited. Okay. Next entry. So at the end of the reporting date, so after 1 year, first of all, this provision has been incurred. The second entry will be interest cost account debit. Interest cost account debit. to provision liability. And now this has to be this present, this is at present value, so this discount has to be unwinded. So 839619 multiply by 10 multiply by 6%. This has to be created as an interest cost. Okay, so simple, you can see that if I have to prepare a schedule for this 1 2 3, this is your present value, this is your opening balance, right? So opening balance at this is your opening balance, this is your interest cost, and this is your closing balance, right? This is your zero period, so you have to create a provision in the zero period, and this provision is 839619. This will become your opening balance. Then you have to incur 6% interest cost on this amount, right? And this will be your closing balance in the first year. So I'm just preparing a 3-year schedule, right? What will be my interest cost? What will be my closing liability? 6% interest in the second year is 53,400. Again, 6% interest in third year. So this liability become 10 lakh rupees. Now this has to be paid, right? Clear? I hope it is clear to all of you. Accounting entry is simple. Every year you have to debit interest cost, credit your liability. Okay. Any doubt? Any problem? Any challenge? Good. Very good. So let's again go back to my PPT. So this we have covered, this present value factor, this present value thing, right? Future events. Now, if we are creating a provision, right? For example, in this case, where this provision has to be settled after 3 years, okay? And there are some future events which is likely, okay? There are some future events which are likely. So whether we need to adjust our provision with those future events, answer is yes. For example, future events that may affect the amount required to settle an obligation shall be reflected in the amount of provision where there is sufficient objective evidence that they will occur. Okay, they will occur. For example, the company does not have any constructive obligation as well as a legal obligation to clean up the environment, right? If the company is emitting some chemicals or the company is emitting carbon, so the company is not liable legally for cleaning up the environment. And even though the company does not have any published policies also, the company does not have a past pattern or practice also, right? But there is a law which is going to be enacted, right? There is a legislation which is going to be enacted. So it has not been enacted, but there are high chances that this law will be enacted, and this law will be enacted retrospective. Means on the date of enactment of law, if the company has impacted the environment negatively in the last 3 years, for example, the company has to pay a penalty of this much amount, or the company has to incur some expenses for cleanup of environment, right? When I say cleanup of environment, for example, in case of chemical or acid factories, they are installing water treatment plants. In case of these companies which are emitting pollution, so they are putting some equipment which is not polluting the air, or let's say they are planting more trees so that the environment will be maintained. Okay, so friends, if there is a legislation and it is probable that this legislation will be enacted, right? So it is certain that this legislation will be enacted. In that case, while creating a provision, these future events needs to be taken into consideration, and amount of provision has to be measured or adjusted accordingly. The effect of a possible legislation. Example, the effect of a possible new legislation is taken into consideration in measuring an existing obligation when sufficient objective evidence exists that the legislation is virtually certain to be enacted, right? For example, the draft has been passed, right? And it is virtually certain that this will be enacted. Okay, So guys, and for example, the legislation says that if any company has impacted the environment negatively in the last 3 years, they have to pay an extra penalty of 20 lakh rupees. Apart from incurring the cost to clean up the environment, they have to pay extra penalty of 20 lakh rupees, right? So in this case, while creating a provision, we have to be extra cautious, and we have to taken into consideration, we have to factor this 20 lakh rupees, while creating a provision. Although this is a future event because this law has not been enacted, but it is virtually certain that it is going to be enacted. In this case, we have to take the impact of this legislation into consideration while creating a provision. Okay. Sairam is asking, sir, why interest cost is booked every year? Sairam, please see, this provision is going to be settled after 3 years. Am I right? This provision is going to be settled after 3 years. So after 3 years, you have to pay 10 lakh rupees. And that is why you are creating a provision today. And that is why you have created a provision at present value. Right? So the today value is 839,619. After 3-year value is 10 lakh. So what will be the differential? So Sainam, from 839,619, how we will arrive at 10 lakh rupees? And if we have, so you have also seen that in Ind AS 109 and in many other Indian accounting standard, you have seen that if you are measuring something on present value, so you have to unwind the discount also. If you are doing a discounting, you have to unwind the discount also, right? So if the present value is 839,619, then what is the difference between 10 lakh and 839,619? The difference denotes your finance cost, your interest cost. As simple as that. This is an interest element, and that is why every year you will debit interest cost and you will have to credit liability, so that this 839,619, this present value, will go to the future value. This present value should be, so that this present value will become equal to 10 lakh rupees, right? So interest cost here implies, Sairam, Jay, that we are having a liability of 839,619 towards an outsider, right? But we will settle to the outsider after 3 years. We will pay after 3 years. It means we are using his funds, and that is why we are creating a provision. So the base amount is 839,619 today, but after 3 years we will pay along with the interest cost, right? So 839,619 plus interest is equal to 10 lakh rupees. I hope it is clear to you, Sairam and Jay. Thank you, Megha. Thanks, Bibhu. Yeah, good. So guys, in case of future events, for example, a possible legislation, so you have to take the impact if it is virtually certain that this legislation going to be enacted. So you have to take the impact of this possible new legislation while creating your provision. Expected disposal of assets. For example, you are creating a asset retirement obligation, right? Today you are creating a asset retirement obligation, provision for ARO, asset retirement or dismantling obligation. You are debiting your property, plant and equipment, and you are crediting your asset retirement obligation. So when you will dismantle the asset, you will sell the asset into scrap also. So standard says that gain from the expected disposal of assets shall not be taken into account in measuring a provision. So guys, you have to create a provision for all possible losses, but you are not creating a provision for all possible gains, right? You know the golden rule: nominal account, personal account, real account. Nominal account, debit all expenses and losses, credit all income and gain. But and what is the law of conservatism? What is the principle of conservatism? That the possible or expected losses has to be recognized, but expected income is not going to be recognized until and unless it become virtually certain, right? It become virtually certain. So that is why if an outflow is probable, then we are creating a provision in the books of accounts. There are more than 50% chances that yes, we may incur a liability. So we have to create in our books of accounts. But in case of asset, if it is probable but not virtually certain, we are not creating an asset in the books of accounts. We are showing it as a contingent asset, right? Clear? So friends, we talked about best estimate, we talked about present value concept, we talked about future event, we talked about in case of an expected disposal of asset, we are not taking into consideration the gain from expected disposal of asset while creating a provision. We will not deduct this gain from this, we will not deduct this gain from expected disposal of asset into our provision, right? So we have discussed these four aspects: best estimate, present value, future events, and expected disposal of assets, right? Good. Let's discuss one case study on future events. X Chemicals Limited engaged in the chemical industry. X Chemical Limited is a company engaged in the chemical industry, causes environmental damage by dumping waste in the river near its factory, right? So this company is a chemical company and they are causing environmental damage. Why? Because they are dumping the chemical waste in the river near its factory. It does not clean up because there is no environmental legislation requiring cleanup, and X Chemical Limited is causing damage for the last 40 years. See the situation of this company. There is no legal obligation to clean up, right? There is no environmental legislation requiring cleanup, and this company is dumping its waste in this river since last 40 years, right? They are damaging the environment since last 40 years. As on 31st March 2002, the state legislation has passed a legislation requiring all polluting factories to clean up the river water already contaminated. The formal gazette notification of the law is pending. So it has been passed, but the formal gazette notification of the law is pending. The formal notification does not announce, has not been notified, but this law has been passed and it requires that all the polluting factories to clean up the river for the water already contaminated. How should X Limited deal with this situation? So guys, tell me whether the provision of this law has to be taken in consideration. First of all, tell me whether this company has to create a provision because the law has not been notified. So whether this company has to create a provision, answer is yes, because there is a present obligation arising out of the past event. Why? What is a past event? Past event is contamination. Past event is damaging the environment, right? And there is a present obligation, yes, because it is virtually certain, because this law has been passed and only the notification is pending, and it is virtually certain that yes, this will happen, this law will be notified, right? And that is why the impact of future event needs to be taken into consideration while creating a provision, and provision needs to be created. The obligating event in this case is the contamination of water, and because of the virtually certainty of the legislation requiring cleaning up, an outflow of resources is certain. It is possible to arrive at best estimated cost for the cleanup activity, right? So first of all, present obligation due to past event is there. Why? Because there is a virtual certainty of legislation requiring cleanup. Second, outflow is probable. Third, you can arrive at a cost. Cost is measurable. That what will be the cost for cleanup activity. So a provision should be recognized in the books of X Chemical Limited for 1-2 for the year 2001-2. Any doubt, students, here? Any doubts? Any problem? Students, let me know if you have any doubt, any problem. Yeah. Good. Okay, good. Megha, any doubt here? Utkarsh, good. Let's move on. So we are discussing the measurement concept. Okay. So we have discussed four aspects here, that how to measure a provision. and we have discussed 4 aspects here. Okay, so now let's discuss the concept of reimbursement. So students, for example, there is a, let's say, reimbursement. For example, there is a manufacturer. Okay, there is a supplier, and there is a customer, right? And the supplier is, for example, the supplier is taking goods from the manufacturer, and supplier is supplying to customer. And the supplier is responsible for providing warranty to the customer, right? And supplier is selling some product, and supplier is giving a warranty to this customer. So if there is any fault, this customer will come to the supplier from whom he has purchased the goods, right? And in return, the supplier will demand this warranty. So supplier will go to manufacturer, and supplier will get the reimbursement of the warranty cost. Okay, so supplier has to make good the loss which is happen with the customer, and supplier will get the reimbursement from the manufacturer, right? Now the question arises, if there is a provision, and of course these parties are different, this manufacturer is different, supplier is different, customer is different, right? Supplier is responsible towards customer, and manufacturer is responsible towards supplier, right? So in the books of supplier, whenever the supplier will sell goods, supplier has to create a provision for expenses, right? For example, in the as per the past trend, if supplier is selling 1 lakh quantity of goods, so probably 5,000 will come for a repair or warranty. It means there is a 5% chances of provision. There is a 5% chances where the provision for warranty is required. Okay, so friends, in this case, whatever supplier will incur, he will get the reimbursement from the manufacturer as per the contract. So friends, one part is your provision for warranty, second part is your reimbursement from the manufacturer. So provision for warranty is an expense for the supplier. For this supplier, provision for warranty, this is an expense, this is an expense, and the second one is reimbursement income. Reimbursement, right? This is an income. Now tell me how this reimbursement and provision has to be treated in the books of supplier. Standard says that in the profit and loss account you can net off, right? For example, 100 rupees warranty provision you have created, and this 100 rupees reimbursement can happen, so you can net off and you can show it as a zero. Second example, if the provision for warranty is 1,000 rupees and the likely reimbursement is 800 rupees, then 200 rupees has to be netted off as an 200 rupees has to be netted off as an so 1,000 minus 800, 200 rupees has to be shown as an expenses, right? So in the P&L, this reimbursement and provision has to be netted off, right? But in the balance sheet, standard says that because this liability is towards a different person, and this reimbursement has to be taken from a different person, even though if this manufacturer will not provide a warranty to the supplier has to pay to the customer, right? Because supplier is responsible towards customer. That is a separate aspect, that supplier will file a suit against manufacturer, so that is a different aspect. But yes, till the time he will not get the reimbursement, so this asset will be shown in the balance sheet. But as far as liability is concerned, the supplier has to perform its obligation, supplier has to pay the liability, supplier has to make good the losses which has been made to the customer, right? So in the balance sheet, this asset and liability has to be shown separately, but in the P&L we can net off this reimbursement income and expenses. Okay, so in case of expenditure required to settle a provision is expected to be reimbursement by another party, the reimbursement shall be recognized when and only when it is virtually certain that reimbursement will be received if the entity settles the obligation, right? The reimbursement shall be treated as a separate asset, and the provision is of course treated as a separate liability. The amount recognized for the reimbursement shall not exceed the amount of the provision. And while creating a reimbursement asset, you cannot recognize the reimbursement amount more than the provision, because probably manufacturer will not pay you more than what you have incurred, right? What is likely to be incurred. In the statement of profit and loss, the expenses relating to any provision may be presented net of the amount recognized for a reimbursement. But in the balance sheet, this reimbursement has to be shown as a separate asset, so that the user of the financial statement will be able to understand that, okay, this amount has to be received from the other party. This amount has to be payable to the other party. Okay, right? I hope this reimbursement portion is also clear to everyone. Is it clear? Is it clear, friends? So let me discuss a reimbursement case study from Institute study material. Please let me know if the Institute study material is visible. I hope it is visible. Yeah. So friends, let's discuss this reimbursement example illustration number 9. Illustration number 9 from Institute study material. X Beauty Solutions Limited is selling cosmetic product under its brand name B, but it is getting its product manufactured from Y Limited. So X is selling cosmetic products to the customer, and the manufacturer is Y Limited. So X Limited is getting goods, purchasing goods from Y, and X is selling to the customer. It has an understanding, and it is not only understanding, there is an enforceable agreement with Y Limited that if the company becomes liable for any damage claims, if the company becomes liable for any damage claims due to any injury or harm to the customer of the cosmetic products, 30% will be reimbursed to it by Y Limited. So there is an agreement, if the product becomes faulty and it will, and if it provides any injury or any damage to the, due to the cosmetic product, if the customer will be negatively impacted, sorry, then 30% will be reimbursed to it by Y Limited. For example, if X has to pay 1 lakh rupees to a customer, 30,000 will be reimbursed by Y. During the financial year 2001-2, a claim of 30 lakhs becomes payable to customers by X Beauty Solutions Limited. How should X Beauty Solution Limited account for the claim that becomes payable? Tell me. So the claim is 30 lakh rupees, right? Raised by the customer to X Limited. And there is a contract between X and Y for the reimbursement of 30%. So tell me how this 30% needs to be accounted for, how this 30 lakh needs to be accounted for in the balance sheet, in the P&L. So friends, first of all, in the balance sheet, this 30 lakh rupees claim has to be shown as a provision, right? Till the time it is not getting settled. 30% of 30 lakh, 9 lakh rupees has to be credited as a reimbursement asset. Why? Because it is virtually certain, because this agreement is there, right? In the P&L account, this this provision of 30 lakh has to be reduced by 9 lakh rupees, which is getting reimbursed by the Y Limited. Since the understanding results in an enforceable agreement, the reimbursement of 9 lakh shall be recognized as a reimbursement right, and provision will be recognized for 30 lakh in the balance sheet. The reimbursement right shall be treated as a separate asset and shall not be offset with the provision, right? But in the statement of profit and loss, the expense may be presented as 21 lakh after offsetting the reimbursement right. Okay. In the P&L, net 21 lakh provision needs to be shown, but in the balance sheet, 30 lakh and 9 lakh has to be shown separately. Okay. Yeah. Is it clear to everyone, friends? Any doubt? Jay, Srinidhi, Sairam, Utkarsh, Megha? Any doubt so far, Mahendra? Okay, let's move on. Review of provisions. So friends, we have discussed what is provision. We have discussed what is the recognition criteria of provision. Once you have decided that yes, this provision needs to be recognized, then how the provision has to be measured. Now we are talking about a review of provisions on every reporting date. The standard says that review and adjust the provisions at each reporting date and adjust it to reflect the current best estimate. For example, there is a legal case which is going on, and this legal claims took years on years. Okay, so when the customer has filed the case, and on the first year, the advocate has the advocate has advised the company that probably 5 lakh rupees needs to be payable to the to this customer while settling this claim, right? But when the case progresses, at the end of the second year, the councils are saying that the demand of the customer has been increased, right? And it's not 5 lakh now. Probably we may end up paying 8 lakh rupees or 9 lakh rupees to this customer. So if you have created a provision on the basis of 5 lakh in the last year, you need to revise your estimate and you have to make provision on the basis of 9 lakh rupees or 8 lakh rupees in the second year, right? So first of all, till the time it is provision, you have to review and adjust provision at each reporting date so that it will reflect the current best estimate, right? Because it is an estimate, it is not actual, it is an estimate. So this estimate needs to be reviewed on every reporting date. Outflow no longer probable, provision is reversed. For example, you have sold a product on a warranty is for 1 year, right? And you have presumed that on the basis of past precedent, you have created a provision of 10%. For example, 1 crore rupees of sale is there, so you have created a provision of 10 lakh rupees, right? You have created a provision of 10 lakh rupees. So friends, if you have created a provision of 10 lakh rupees and 1 year has been passed and there was only 2 lakh rupees of warranty which came from the customer, right? So now this 1 year has been passed. Even though if the customer will come now, the company will not entertain because it is out of warranty. So the company will make good the loss, but the company will recover from the customer, right? So in this particular case, at the end of the reporting date, this 8 lakh rupees of provision is not required. You have created a provision of 10 lakh rupees. 2 lakh rupees you have actually passed on. But now this 8 lakh liability will never come. Why? Because the warranty period is over now, right? So standard says that if outflow is no longer probable, then you have to reverse the provision. You have to reverse the provision, right? So what accounting entry you need to pass? You need to reverse your liability provision liability account debit to either other income, or you can credit your expense also, right? Provision shall only be used for the purpose for which they were originally recognized. You cannot do that. You have created a provision for warranty, right? So this provision for warranty has to be used only for the warranty purposes. You cannot do that. You will debit the provision for warranty and you will credit the provision for asset retirement obligation. So basically you are saying that instead of creating a provision for asset retirement obligation, let's continue the provision for warranty only. You cannot do that, right? So provision has to be used only for the purpose for which they were originally recognized. So in this case, this warranty provision needs to be reversed and the ARO provision needs to be created separately. Okay, there will be two entries, not the one entries. Okay, clear? Jay is asking, sir, netting of offsetting is not allowed in balance sheet but in P&L for reimbursement. Yes, Jay, in P&L offsetting is required, but in balance sheet offsetting is not required in case of reimbursement in Ind AS 37. Why? Because this reimbursement has to be taken from a separate party and the liability is towards a separate party, right? But in income and expenditure account, in P&L account, so that actually your reimbursement is not your income. So the objective is why you are getting a reimbursement, because you are incurring a provision of, you are incurring an expense, right? So that is why this expense can be netted off with the income. This income will be netted off with the expense, because this reimbursement is actually not an income, right? So let's talk about some specific guidance provided by Ind AS 37. Executory contract we have already discussed. Executory contracts are contracts under which neither party has performed any of its obligation, or both the parties have partially performed their obligation to an equal extent. This standard does not apply to executory contracts unless it becomes an onerous. So this standard is not applicable on non-onerous executory contract. This standard is applicable on onerous executory contract. Executory contract we have discussed. Now we need to discuss what is meant by onerous contract. This is a very important concept, right? So what is meant by onerous contract? Onerous contract means a loss-making contract. For example, there is a contract where unavoidable cost of meeting the obligation under the contract will exceed the economic benefit expected to be received under it, right? So onerous contract, friends, let me talk about onerous contract. For example, the company has taken a premise on a lease basis for 10 years, and this lease is a non-cancelable lease, right? So the company has run their operations for 4 years. 6 years is still to be passed on, okay? But the demand for the product for which the company was doing this manufacturing has been declined. The demand has been declined for this product, right? So now what happens? Since the demand has been declined, the company has decided to shut down the factory, or the company has decided to stop the operations, right? But even though if the company will stop the operation today, shut down the factory, still the company has to pay the rent for 6 years, remaining 6 years, right? Why? Because there is a non-cancelable lease contract, and there is a penalty clause for termination of the lease contract before the stipulated time. So the company has to pay a lease rent for next 6 years also, right? So now the question arises, the company will have to pay the lease rent for next 6 years, but the company will not receive any economic benefit from using this particular premises, right? So in this case, it will become an onerous contract, or the cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. For example, the company has decided to sublease this building, right? So the company has taken this building on a lease, rent of rupees 5 lakh rupees per month, but the company is now expecting to receive a rent of 3 lakh rupees only, right? So whatever the company is incurring and whatever the company is getting, the benefit which the company is getting is much lesser than the expense which the company is incurring. So it will become a loss-making contract. This lease contract will become an onerous contract, right? And once a contract will become an onerous contract, it will come under the kitty of Ind AS 37, right? And in that case, the company has to create a provision. The company has to create a provision. And the company has to create a provision of what? The company has to create a provision at lower of the cost of terminating the contract. I mean to say, if the company will terminate the contract today, the company will have to pay a lease rent of next 6 years. So what is the total penalty? For example, the total penalty is, let's say, 50 lakh rupees. The total lease rental is 50 lakh rupees. And the net cost of the continuing with the contract, for example, the company will continue with the contract. Let's say 50 lakh rupees the company have to pay, but the company will be able to receive 30 lakh rupees from continuing the contract and getting the contract sublease, right? So the company will say, even though if I'll hand over this building, hand over this premise to the landlord, still I need to pay 50 lakh. Then why not sublease this, get some money, and continue this for the next 6 years, right? So if the company will sublease, it will receive 30 lakh rupees rental. It has to pay 50 lakh rupees rental. So 20 lakh rupees is the net cost, for continuing with the contract. 50 lakh rupees is the net cost for walking away from the contract, right? So the company needs to create a provision at lower of cost of terminating the contract and cost of continuing the contract. What is lower? 50 lakh is lower or 20 lakh is lower? 20 lakh is lower. So this 20 lakh rupees provision has to be created upfront when this contract will become a onerous contract, right? Is it clear? So an onerous contract is a contract in which the unavoidable cost of meeting the obligations under the contract exceeds the economic benefit expected to be received under it, right? So unavoidable cost of meeting the obligation exceeds the economic benefit expected to be received under this. So whether the contract is onerous in the first place, you need to see whether the cost is greater than the economic benefit, it will become an onerous contract. The present obligation under the contract shall be recognized and measured as a provision, right? And this measurement will be at a lower of what? Lower of cost of terminating contract, cost of terminating contract, cost of breaching the contract, and cost of meeting the contract. Meeting means continuing, right? So if a contract can be terminated without penalty, sir, if there is no penalty clause in the contract, right, the lessee can walk away at any point of time from the contract. In that case, whether it is onerous contract, in that case, it is not an onerous contract, right? It is a non-onerous contract. Clear? So example of onerous contract we have discussed: a company that operates profitably from its current leased building relocate its operation to a building but pays rent during the remaining 4-year lease term on the old building has an onerous contract. In this case, company is obligated to make payments but is no longer using the asset. So this will become an onerous contract, right? Let's discuss this case study also. This case study is there in your institute study material as well. X Limited had entered into a non-cancelable contract with Y Limited to purchase 10,000 units of raw material at rupees 50 per unit at a contract price of rupees 5 lakh, right? So 50 multiplied by 10,000, 5 lakh rupees, right? As per the terms of the contract, X Limited would have to pay 60,000 to exit the contract. So guys, what is the cost of termination? What is the cost of termination? What is the penalty cost? If this X Limited will not honor the contract, it has to pay an obligation. It has to pay a penalty of 60,000. X Limited has discontinued manufacturing the product that would use the said material. This contract become onerous. Why? Because whatever raw material has been contracted for, this X Limited has discontinued manufacturing the raw material, this particular material, right? X Limited has identified a third party to whom it can sell the material at rupees 45 per unit. But so if X Limited would not take the delivery of this goods, then X Limited has to pay 60,000. But if X Limited will take delivery of the goods, cost of continuing the contract, cost of continuation. In this case, X Limited has to incur a cost. How much cost X Limited has to incur? X Limited has to incur a cost of rupees 5 lakh rupees, 50 multiplied by 10,000. But X Limited can sell this material at 45. So what is the sale price? 45 multiplied by 10,000, 4,50,000. So what is the net loss by taking delivery? What will be the net loss to X Limited? The net loss will be 50,000 to X Limited. If X Limited will terminate the contract, the cost will be 60,000 of penalty. If X Limited will continue the contract, the net cost will be 50,000 rupees. So what is lower? Lower is 60 or 50? 50 is lower. Cost of meeting the contract and cost of breaching the contract. So cost of terminating the contract is 60,000. Cost of continuing the contract is 50,000. So provision has to be created for 50,000. These circumstances do indicate an onerous contract. The only benefit derived from the purchase contract of rupees 5 lakh is proceeds from the sale of the contract for rupees 4.5. Provision should be recognized for least cost of exiting the contract and fulfilling the contract. Exiting the contract is 60,000. Fulfilling the contract net cost is 50,000. So provision for onerous contract is 50,000, right? And what is the accounting entry? Provision for onerous contract expense debit 50,000 to provision liability credit 50,000, right? Is it clear, friends? Any doubt here? Any doubt so far? Is it clear? So I have included so many case studies in my PPT. So I will share this PPT with Board of Studies today. And on every aspect, there is a case study. On every concept, there is a case study, so that you will be able to understand what is the concept, right? So students, it's 8:15 now. Let's have a break for 10 minutes and we will start at 8:25. Okay. And let me know if you have any queries. Please write down your query on the query box of ICI, query link of ICI, so that after break I'll resolve those queries. Okay. And first of all, let me look at the query. So Namita is saying, sir, if in FY 2021 company establish new constructive obligation, can it recognize provision of it? Yes, Namita, it can recognize provision. Jay is asking, provision is created because company is not clear what course of action or termination or continue. In future, decision to continue taken, provision reversed. So Jay, see, for example, the when the contract will become onerous, the contract will become onerous because there is a penalty clause. Okay, there is a penalty clause. So it means even though if the company will not have benefit, for example, if you will deny that you will not accept the delivery of the goods, right, you will have to pay a penalty. So you have not taken the goods, but you have to pay a penalty. It means it is a loss making contract. In case of a loss making contract, you need to see, if today I will exit from the contract, I have to bear X cost. If I will not exit from the contract, but I will, if so I will not exit from the contract, but I have to continue with the contract. Then what benefits I can arrive? What benefits what benefits I got from the continuing the contract? For example, in the last example, we have seen that from exiting the contract, we have to pay a penalty of 60,000. But from continuing in the contract, we will be able to bear a loss of 50,000 rupees. So the net, the lower of the both of the above, the lower of the both has to be taken into consideration as a provision, right? So J, it is not like that the provision is created because company is not clear. The provision is created because the net cost, the net cost has to be incurred, right? For example, if the company will exit, 60,000 is the cost. If the company will not exit, 50,000 is the cost. So bare minimum, this is the amount which company has to incur as a loss, right? So provision has to be created for that amount. Okay, sir, for example, if the company wants to continue with the contract and the company is not certain that the company will be able to sublease or the company will able to have the buyer, okay, so the company is not expecting any revenue from this particular premise or from this particular goods, then in that case, in the last example, 5 lakh rupees of the goods which the company wants to purchase, right? So the company wants to continue with the contract. So the company purchase this 5 lakh rupees of goods. So when the company will purchase 5 lakh rupees of goods, this entire 5 lakh rupees has to be recognized as an expense. Okay. Second, in my example of 6 year of lease, right? So the company has to create a provision for the entire money, for the entire 6 years amount as a provision, today, as a loss provision, right? Namita is asking, sir, company should also need to prove to auditor that contract is onerous. Otherwise, to create more provision, it can make any contract onerous. You are right, Namita. Yes, as an auditor, you need to see why it is onerous, right? Why it become a loss-making contract. Of course, as an auditor, you have to see this. Okay, the management should have a proper evidence of that. The management should have proper reason for that. Why management is calling it as an onerous? For example, in the last case study we have seen, the buyer does not wants to purchase these goods. Why? Because the buyer has already discontinued, or the buyer has stopped the manufacturing of the goods in which this raw material is getting used, right? So the auditor needs to see factually this is the situation or not. If the buyer has already discontinued the product in which this raw material will be there, of course, in that case, this penalty is become a loss making thing, and the company has to create a provision. And now as an auditor, what you will see, what the contract says. If the contract says, if you will not take the delivery, you have to pay 60,000, then of course you have to create a provision of 60,000. But if the company will create a provision of 50,000, you need to see that if you want to continue, do you have any market assessment of that? Do you have any buyer of that, right? So that the buyer will purchase the goods at 4,50,000 and you will be able to sell it at 5 lakh rupees, right? So you have to do these kind of assessment as an auditor. Even as a management, you have to do these kind of assessment. Clear? Is it clear? Yeah. Coming to the restructuring, what is meant by restructuring? So friends, you have seen that these big companies are relocating its from one place to another place. These companies are relocating its business from one place to another place, right? These companies are relocating from one state to another. For example, Tata Motors, you must have heard about when this Tata Motors has installed a nano plant. So Tata Nano in Singrur, West Bengal, right? So due to the political issue or due to XYZ issue, they have relocated the plant from Bengal to Gujarat. Okay. So restructuring means you already have read or understood Ind AS 105, non-current asset held for sale and discontinued operations, right? So a company which is discontinuing operation, what is that? That is kind of a restructuring for that company, right? So restructuring means like sale or termination of a line of business. For example, if tomorrow Tata Motors will say that I will discontinue my passenger vehicle section, right? Passenger vehicle segment. So it means the Tata Motors is selling or terminating a line of business. So when Tata Motors is announce its operation, announce its discontinuation of an operation, right? So in that case, as an auditor and as a management, you need to see that whether I need to make a restructuring provision. For example, I'll take a classic example here. When Tata will say that, I'm just taking an example, this is not a news, okay? So for example, X Limited will say that, we will discontinue our Manesar plant, okay? And X Limited has already announced a decision that we have 5 plants and we will discontinue Manesar plant and other 4 plants will continue, right? So first of all, the laborers or the workers or the person who are working in Manesar plant, right? So when the company will announce this decision, so of course the provision for redundancies has to be taken into consideration. For example, company is saying we will discontinue the Manesar plant in the next 2 months, right? And as per the contract, there is a notice period of 3 months. So in that case, the company has to pay for the termination thing. The company has to pay a notice period pay to its employees, right? So when the company will announce this kind of announcement, so then in that case, it will be considered as a restructuring, and the company has to create a provision for restructuring. The company has to create a provision for termination also, right? So restructuring could be, what could be the example of restructuring? The restructuring example is sale or termination of a line of business, closure of business location in any country, in a country or region, or the relocation of business activities from one country to another country, right? Second example, a company is moving its plant from one place to another, right? They have taken offices also. They have taken offices also at that place. So when the company is moving from this place to this place, there was some non-cancelable lease agreement, right? So whenever the company will plan, whenever the company will announce that we are closing business in this particular state and we are moving from this state to another state, so again, in that case, this is known as a restructuring, and the provisions are required for restructuring. The provisions are required for closure of business, right? The provision are required in case of any redundancies, any termination, any separation, any onerous contract. The provisions are required to be made. Okay. Change in management structure. Okay. So sale or termination of a line of business, closure of business location, and change in management structure is also an example of restructuring. Okay. So these are the 3 examples of restructuring which is given in the standard. Okay. So what could be the restructuring costs? First of all, restructuring is a kind of constructive obligation. Sir, if the board has decided that yes, we have to relocate this plant from this place to another place, right? In that case, whether the provision for restructuring is required, answer is no. The provision for restructuring is required only. The provision for restructuring, this will become an obligation only when this plan has to be announced, when the plan will be announced to the impacted parties, when the plan will be announced to the employees, to all the stakeholders, right? When this plan will be announced in public, when this plan will be announced, restructuring plan will be announced to the impacting parties, then only you can say that this constructive obligation has been arised. Because when this plan will be announced, it will create a valid expectation in the mind of impacting parties that yes, this restructuring will happen. Okay. and and the company must have a detailed formal plan for restructuring. So for creating, for example, this Tech Mahindra has bought Satyam, right? Or for example, this Hindalco Industries Limited has discontinued operations, right? So they have sale a subsidiary. Okay. So friends, if you are an auditor of the company, so whether provision for restructuring has to be taken or not. For example, you are auditing board minutes, and in the board minutes you found that the company wants to discontinue one of its plant, right? And you are the auditor of that company. So will you tell management to create a provision for restructuring? So any cost which is relating to restructuring, relating to shifting of business, relating to closure of business, will you advise management to create a provision for restructuring? Before advising management to create a provision for restructuring, you have to look at two aspects. First, you have to check whether there is a detailed formal plan of restructuring. Detailed formal plan. The first thing is whether there is a detailed formal plan of restructuring, right? I'll discuss what is meant by detailed formal plan of restructuring, right? First. Second, there will be a communication. There should be a communication of restructuring. Communication of restructuring to the impacting parties. Right? There should be a communication of restructuring to the impacting parties, right? A board decision alone does not create a constructive obligation. I have told you on the basis of board minutes. So board of directors has sit in the board meeting and they have approved a plan. It does not mean that you have to create a provision for restructuring, because restructuring provision will be created only when there is a constructive obligation. Constructive obligation arises only when the company either will publish it's on its website, or the company will communicate to the impacting stakeholder, right? So what is included in the detailed formal plan of restructuring? The business concerned. What business you are going to restructure? Principal locations affected. Which location will be affected? How many warehouse, offices, plant, your stock points, depot, right? So you have to, so basically what is the business you are discontinuing or restructuring? How many locations have been impacted? Function and number of employees who will be compensated. How many employee and how many functions will be compensated? How much expenditure needs to be undertaken? What is the timing of implementation of the plan? Whether it has to be concluded or completed within 6 months, within 1 year, within 5 months, right? So this has to be also part of the restructuring plan. Sir, if the plan has been communicated and a detailed plan has been made, so what kind of cost needs to be taken into consideration for creating a provision? So necessarily entailed by restructuring, only the cost which is necessary entailed by the restructuring needs to be taken into consideration. For example, if there is any legal cost, there is any shifting cost, there is any employee compensation. So due to restructuring, if there is any cost which is necessary to be undertaken, has to be taken into provision, has to be taken into consideration for creating a provision, not associated with the ongoing activity of the entity. And these costs should not be associated with the ongoing activity of the entity. For example, the company is relocating its plant from India to China. Okay. And for that purpose, the company has hired a Chinese language company. Okay. And this Chinese language company will take 1 crore rupees for for giving a training on the Chinese language to the employees, right? So this cost is not related to restructuring. This cost is relating to the ongoing activity of the company. Ongoing activity of the company, right? Because if this company has to move its operation from India to China, the employee has to understand the Chinese language so that they will be able to communicate, they will be able to converse in that language with the local residents there, right? Restructuring cost does not include, what does not include? Marketing cost, right? retraining or relocating continuing staff. So the company is paying for the ticket expenses from India to China for the staff who is getting relocated. The staff who is retrenched, please try to understand the difference, right? First, staff or employee who is terminated, and the staff who is relocated. The staff who is terminated and staff who is relocated. The staff who is terminated is not related to the ongoing activity of the company. The staff who is terminated is relating to the restructuring, relating to the impact of restructuring, relating due to the restructuring. But staff who is relocated is due to the ongoing activity of the company, right? So retraining or relocating continuing staff expenses will not come under the restructuring, but yes, the terminating staff expenses will cover under the cost of restructuring. Investment in new system and new distribution networks, like PepsiCo. PepsiCo has, shifted from their old building to a new building in Gurgaon. So they have invested new systems, they have invested in new network, new cost, furniture, right? So this new investing in new systems and distribution network will not come under the cost of restructuring. It is relating to the continuing business, right? And hence it will not created as a provision for restructuring. So guys, provision for restructuring is more from the perspective of, like we have understood, onerous contract. So what you do in case of onerous contract, if a contract will become onerous, you are creating a provision upfront, right? What loss you are getting into, what loss you will be suffering, so you will create a provision upfront, right? So likewise, if you have communicated a plan for restructuring, you have to create a provision for that, which is only relating to the restructuring, which is not relating to the future, which is not relating to the ongoing activity of the entity. I hope you guys have understood, right? So Namita is asking, sir, will removal of Mr. X from management amounts to change in management? So Namita, removal of Mr. X is not amounting to change in management. Change in management means, for example, earlier this company was having a control of by A Limited. Now this A Limited board has been shifted, and this company is getting a control from B Limited. So this is change in the management structure, right? So earlier it was controlled by Reliance Group. Now it is controlled by Adani Group. So the management has been changed, right? For example, in startup, thus in startup there are a lot of PE investors, right? So these managements are changing. Okay, so this is known as a restructuring. So I'm not saying that if the management is changing, then also you have to create a provision. I'm not saying that. I am saying what is meant by restructuring, right? Srinidhi is asking, sir, whether restructuring costs are incurred when discontinuing operation disposal group takes place. Yes, Srinidhi, restructuring costs are incurred when discontinuing operation and disposal groups are takes place. You are right. Right, guys? So let's discuss a case study. Okay, then we'll discuss more about this. So we have discussed three things. First, example of restructuring. Restructuring means sale or termination of business, like discontinuing operation, right? The closure of business locations in a country, in a region, right? From one state to another, from one region to another. So from moving from one place to another, right? One country to another, or change in management structure. These are example of restructuring. So restructuring cost will incur when there will be a constructive obligation, and constructive obligation will arise when there is a proper communication of this restructuring plan to the impacting parties, and there should be a detailed formal plan for that, right? Detailed formal plan will include what business you are discontinuing, what are the principal locations which have been impacted, the function and number of employees who will be compensated, what is the expenditure which has been undertaken, and timing of implementation of the plan. Okay. Restructuring cost inclusion and exclusion. So for example, uh, coming to the restructuring cost, you need to take a provision of restructuring cost only the cost which is related to restructuring and which is not associated with the ongoing activity of the entity. If the cost is relating to the ongoing activity of the entity, it is not relating to the restructuring. So for the sake of remembrance, you can just remember, if a staff who is getting terminated, it will come under restructuring. If a staff who is relocated to a new to a new place, it is not related to restructuring. So you will always be able to remember this example, right? X Cements Limited has 3 manufacturing units situated in 3 different states of India. The board of directors of X Cements Limited, in their meeting held on January 10, 2011, decided to close down its operation in one particular state on account of environmental reasons, right? So they have 3 manufacturing units in 3 different states of India. The board, in their meeting held on 10 January, decided to close down one of its operation in one particular state due to some environmental reasons. A detailed formal plan for shutting down the above unit were also formalized and agreed by the board of directors in that meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred. Date of implementation of plan has also been mentioned, right? So the detailed formal plan has been made, and everything relating to detailed formal plan, which location is impacted, how many employees needs to be compensated, what is the amount of expenditure, right? What are the number of employees, what is the business which has to be discontinued. So everything is there in the, and the date of implementation of plan. So everything is there. Meetings were also held with the customer. So the first criteria, detailed formal plan has been made, it is there. Second, the communication to the impacting parties should be there. Meetings were also held with customer, supplier, and employees to communicate the feature of the formal plan to close down the operation in the said state, and representative of all interested parties who are present in those meetings. It means with the help with this formal communication, all the impacting parties are also getting communicated. Do the action of the board of directors create a constructive obligation that needs a provision for restructuring? Tell me, in this case, whether it will become a constructive obligation? Yeah, yeah. Whether there is any, tell me, whether it will come under the restructuring? Whether we need to? Yeah. Yes, in this case, the condition prescribed are there should be detailed formal plan and there should be constructive obligation, right? The board of directors have discussed and formalized a formal plan of winding up the operations in the above said state. This plan was communicated to the parties affected and created a valid expectation in their mind that X Cement Limited would go ahead with this plan to close down the operation in that state. Thus, there is a constructive obligation that needs to be provided at year end, right? Namita is saying, sir, in study material, 4th point also there is restructuring. You are right, Namita. So generally, this C and D points are almost same, right? So fundamental reorganization that have a material effect on the nature and focus of entities operations. So this 4th point is talking about if the entity has, reframed, or the entity has done the internal restructuring, right? What is meant by internal restructuring? For example, the company has earlier, the company was supplying goods to directly to the customer, right? So the company is manufacturing goods and the company is selling goods directly to the customers, and the company has just opened their shops, and the company is selling goods to the customer directly. It is a B2C business, business to consumer, business to customer. Now internally the company has done the restructuring. So the company had changed the way the company is doing its operations. So the instead of directly selling the goods to the customer, the company has decided to engage with the dealers. The company has decided to appoint dealers, agents, right? And the company will sell the goods to the dealer and agents, and in turn the dealer and agents will sell the goods to the customer. So this is known as a internal reorganization or internal restructuring. So if this will happen, so as an auditor and management, you need to see that if the company is changing its operation, or the company is doing an internal restructuring, whether there is any need for creating a provision for restructuring, whether any contract will become an onerous contract. For example, the company was having 10 shops at that point of time, and the company was selling these goods directly to the customer. But now the company has decided not to go directly with the customer, but they will go with the agent and distributors, right? So in this case, what about these 5 or 10 shops, right? For example, if these shops were on the leases and some employees were also hired for maintaining or for running their shops, so this provision for redundancies, your lease contract, if it become onerous, so these kind of provision is required to be recognized, right? Understood? In case of change in management structure, of course, there could be some cost of legal fees. For example, if management is changing, so probably there could be some legal agreement or document charges could be there. But in case of management structure, generally there would not be any cost of restructuring. It is an example of restructuring, right, Namita? I hope you guys are able to understand this. Namita, I hope I have answered your both the queries. Yeah. Jay, Srinidhi, Namita, Sai, Utkarsh, Megha. I hope you guys are comfortable so far. Let me know if there is any challenge, any doubt. Yeah, so guys, let me show you one more case study from Institute study material on restructuring. Let me know if this is visible. Let me know if the Institute study material is visible. Example number 32. No implementation before end of the reporting period. On 12 March 2001, the board of an entity decided to close down a division, right? On 12 March 2001. Before the end of the reporting period, that is 31st March 2001, the decision was not communicated to any of those affected and no other steps were taken to implement the decision. It is assumed that a reliable estimate can be made of any outflow expected. So guys, does it matter if the outflow is probable or the reliable estimate can be made, whether it is a constructive obligation? Because this decision has not been communicated to any of the impacting parties. So can we say that the second criteria has been met? Answer is no. So present obligation as a result of past event, right? Present obligation as a result of past event. There has been no obligating event and hence there is no obligation. There has been no obligating event, right? Nothing has been communicated. So there is no constructive obligation. So conclusion, no provision is going to be recognized. Okay. Second, closure of a division, communication or implementation date before the end of the reporting period. On 12 March 2001, the board of an entity decided to close down a division, making a particular product. On 20th March 2001, a detailed plan for closing down the division was agreed by the board. The letters were sent to the customers, warning them to seek an alternative source of supply. This company has communicated to the customer also that we are going to discontinue, we are closing my division, we are closing our division. So you have to check for the alternate source of the goods. And redundancy notices were also sent to the staff of the division. And even the termination letters have given to the staff also that we will giving you 6 months salary or 3 months salary, and this will be your last date. So this notice has also been given. It is assumed that a reliable estimate can be made, right? So first of all, the first thing is whether it will become a constructive obligation. Answer is yes. So whether there is a present obligation as a result of past event. So the past event is, what is the obligating event? The obligating event is a communication of this decision to the impacting parties, which gives rise to a constructive obligation, right? And outflow, if the outflow is probable, yes, outflow is probable because you have to pay a notice to the notice period pay to the impacting parties, customers, employees, and hence a provision is required to be recognized. Provision for restructuring is required to be recognized. Okay, clear? Yes, Namita, you are right. Clear, guys? Any doubt here relating the restructuring? So in example, you would have a case study in this form, right? And there were some costs which have been given, like provision for redundancies, right? Like provision for leases cost, okay? So and provision for staff training for the new environment. So you need to understand that this provision for staff training will not cover under the provision for restructuring, right? So coming to the disclosure, friends, the movement in balances is below. For every provision, for every this kind, like provision for asset retirement obligation, provision for restructuring, provision for warranty, you have to give a complete movement. Like what is my opening balance plus additional provision minus amount used minus unused amount reversed. So first of all, for example, provision for ARO, provision for asset retirement obligation. What is my opening balance? Opening balance is 100 rupees plus the new provision for new sites, for example, it is 50 rupees minus already the provision has been incurred minus amount used is, let's say, 20 rupees minus amount reversed because provision no longer required is has to be reversed minus 10 plus interest cost due to unwinding of discount is, let's say, 20 rupees is will become your closing balance. So 150 minus 10, 140. This is your closing balance, right? So this disclosure is required to be given, and you have to provide the description, timing, and if there is any uncertainty in provision, so you have to provide this detailed category wise expected and recognized reimbursement relating to provision, brief description and financial effect of contingent asset and contingent liability. You have seen that contingent liability has to be disclosed in the notes to accounts, right? If it is impracticable to disclose any of the information, the facts shall be stated. So these are just disclosures. So coming to the difference between IAS 37 and Ind AS 37, there is no difference. But coming to the difference between IGAP, I mean to say AS 29 and Ind AS 37. So there are two differences. First of all, in terms of discounting, in Ind AS 37, if the effect of the time value of money is material, then discounting is required for all kind of provision. But in AS 29, the discounting is only permitted for asset retirement obligation or dismantling obligation. But for example, provision for legal claims, if legal claims is expected to be settled after 3 years, 4 years, 2 years, still discounting is not required in these kind of provision for legal claims, right? Contingent asset in IGAP, contingent asset are required to be disclosed in the board of directors report. It is not required to be disclosed in the notes to accounts. But under Ind AS 37, the contingent asset are required to be disclosed in the notes to accounts, right? So here discounting is permitted for all the provisions. Here only ARO. Here contingent asset is required to be disclosed in the board report, and here in the notes to accounts to financial statement. Okay. So this is required to be disclosed. So friends, I have covered this Ind AS 37, and let me discuss one more case study from the institute study material. So Namita, are you talking about institute study material? If I talk about this institute study material, in the point 1, there is no constructive obligation, right? There is no, this is only the board has decided, the decision has not been communicated, right? The decision has not been communicated, the detailed plan has not been made, right? In that case, there is no constructive obligation, and hence there will not be any provision requirement. But in the second case, the constructive obligation is there, the detailed formal plan has been made, and hence there is a provision requirement, right? Clear, Namita? Or do you have any other question? Is it clear? Or do you have any other question, Namita? X Events Limited, I have already covered. So let me cover one more thing. So this is your, yes, example number 27. Customer X has made a claim of 2 million. Customer X has made a claim of rupees 2 million. Just, yeah, for liquidated damages, for penalty, right, from the entity. The entity is disputing the amount of claim, but the entity is not agreeing with this amount of claim. Due to the uncertainty involved in the amount payable, the entity recognizes this as a provision. Okay. After negotiation with the customer, the amount is agreed at 1.5 million. So initially the company has made a provision of 20 lakhs, but when the negotiation has happened with the customer, the amount has been agreed at 15 lakh rupees. As there is no uncertainty involved relating to the amount payable, it no longer met the definition of provision and should be reclassified to an appropriate category within liabilities, as there is no uncertainty. So question is, sir, earlier the customer was asking for penalty of 2 million and the entity was disputing. Okay. But due to the uncertainty involved, the company has created a provision for that. Uncertainty means whether the company will pay or not pay, right? But after negotiation, the amount is agreed for 15 lakh. The customer has agreed and the company has agreed. So once it has been agreed, it is no longer a provision. Why? Because provision is either a liability, provision is a liability of uncertain timing or uncertain amount, right? So earlier it was uncertain. Even it was not known that whether it has to be payable or not, because the customer and because the company was also disputing. Once it is finalized, it is no longer met the definition of provision. It will become a liability, right? It will become your actual liability. It is no longer a provision. So you cannot show it as a provision. You have to show it as a liability. And even the disclosure relating to provision like opening balance, addition, deletion, closing balance is also not applicable. Clear? Is it clear? Yeah. Friends, do you have any doubt further? Let me know if you have any doubt. Otherwise, I'll move on. X beauty solutions we have already covered. Yes. So let's cover this one case study on expected disposal of asset. I have told you that if there is a gain from the disposal of asset, that gain is not going to be considered while creating a provision, right? For example, you are creating a provision for asset retirement obligation and you are saying that, sir, if I will dismantle my site, I will dismantle my factory, there will be a lot of scrap also, and I will be able to sell the scrap and I'll get the money, right? So standard says that this gain from the expected disposal of asset will not be considered today for the purpose of provisioning. For the purpose of provisioning, this gain will not be reduced from the provision which you are expecting, okay, to be outflow in future. So gain on the expected disposal of asset should not be taken into account in measuring a provision, even if the expected disposal is closely linked to the event giving rise to the provision, right? Instead, an entity should recognize gain on expected disposal of asset at the time specified the standard dealing with the asset concerned. So asset concerned means Ind AS 16. So what Ind AS 16 says that? Ind AS 16 says that gain will be recognized only when then the asset will be de-recognized, right? Asset will be de-recognized, not today. At the end of 2001, an entity is demonstrably committed to the closure of some facilities, having drawn up a detailed plan and made appropriate announcement. So detailed formal plan is there, constructive obligation is there. The expected impact of the plan is as follows. The restructuring cost is 10 lakh rupees and gain from such sale of property is 2 lakh rupees, right? Which will happen after, right? The provision required at the end of year 2001 is rupees 10 lakh. So basically at the end of 2001, the company has announced, prepared a formal detailed plan, and the company has also announced the closure of the facilities, right? And of course, when the company has announced today, the of course some cost will incur day after or incur in the later stage, right? And the company will take time to scrap these all property, plant and equipment. So the company is expecting the cost which will be incurred by 2002 is 10 lakh rupees and the gain from sale of property will be 2 lakh rupees. So the provision, because restructuring is there, so provision has to be recognized upfront. If the time value of money is material, in that case, it has to be recognized on the basis of present value. But the expected gain on the sale of property is dealt as per the separate standard, which is Ind AS 16, which says that the gain has to be recognized when there is a derecognition of the property, right? In PP, so Srinidhi, so let me see. Jay is asking provision for legal claims will be discounted in Ind AS. Yes, but not in old GAAP. Yes, Jay. So in old GAAP, in old accounting standard, so this provision for legal claim will not be discounted, but in accounting standard, these in accounting standard this will not be discounted, but in Ind AS and IFRS this has to be discounted, right? So let me look at more examples and case studies. So quick recap, we have discussed provisions, and we have discussed contingent liability and contingent asset, right? So question number 2, an entity is a telecom operator. An entity is a telecom operator. Laying of cables across the world is a requirement to enable the entity to run its business. So the company is a telecom company, and the company has to lay the cable across the world, and it is requirement to enable the entity to run its business. You must have seen that the company is putting cable inside the earth, right, inside the soil. Okay, cables are also laid under the sea, and contracts are entered into for the same. And these cables are also laid under the seabed. Okay, by virtue of laws of the countries through which the cable passes, the entry is required to restore the seabed at the end of the contract period. What is the nature of obligation that the entity has in such a case? Tell me. So for example, Bharti Airtel Limited has also put some cables in the sea. Okay, and there is a requirement of the law that whenever this contract period will completed, so you have to restore the seabed, you have to remove the cables from the sea. It is not like pulling the wire, it is it is like investing a heavy infrastructure in the seabed, right? So the law requires you have to restore, you have to restore the site, right? You have to incur a restoration obligation in future. Okay, so tell me, what is the nature of obligation? The nature of obligation is asset retirement obligation, restoration obligation, right? And in this case, the entity has to create a provision. First of all, the entity has to see what amount we need to incur after 20 years. And now that amount, then present value has to be measured for that amount, and the provision needs to be created for this amount. Remember, on the Excel file, I have shown you a case study of 50 years for a asset retirement obligation. So let's see the answer of question number 2. Para 14 of Ind AS 37 says that, just a minute. Yeah. A provision shall be recognized when there is a present obligation, legal or constructive, as a result of past event. Outflow is probable and cost can be measured reliably. Further, with regard to past event, it says that past event leads to a present obligation if it is an obligating event. And what is the obligating event? Obligating event could be a legal, could be due to legal could be due to legal, like contractual or requirement of legislation, or it could be due to constructive thing, right? Like published policies, your past practices, patterns, right? So in this case, the provision should be recognized as the obligating event takes place, because the entity is under legal obligation to restore the seabed, provided other recognition criteria has been met. What is the other recognition criteria? Outflow is probable and cost can be measured. Moreover, the amount of the provision would be depend on the extent of the obligation arising from the obligating event. In this case, an obligating event is the laying of cables under the sea. First, we have laid the cable, that is why this restoration will happen. Okay, to the extent the cables have been let down under the sea, a legal obligation has arisen, and that extent provision for restoration of seabed should be recognized. Okay, let's look at another question. Entity XYZ, question number 6, entered into a contract to supply 1000 television sets for 2 million. An increase in the cost of input has resulted into an increase in the cost of sales to 2.5 million. So when the company has entered into a contract, that time the cost of 1000 television was 2 million. But raw material cost has been increased, and now this cost has been increased to 2.5 million, right? So friends, if you will see, for example, I am a supplier and I have entered into a contract with Namita to supply some material, and the cost and the agreement value is 2 million rupees, 20 lakh rupees. So Namita has agreed to pay me 20 lakh rupees, okay, for receiving the delivery of that goods. Now I need to deliver that goods. but before delivering that goods, the raw material prices has grown up, right? And even this raw material cost will become 25 lakh rupees, right? So if I will deliver the goods to Namita, I have to incur a cost of 25 lakh rupees. And in return, what I'll get 20 lakh rupees. So whether it will become an onerous contract or not, this has become an onerous contract, right? So I will get 20 lakh rupees, but I have to incur 25 lakh rupees to earn a revenue of 20 lakh rupees. So it will become a onerous contract, loss making contract. I have to incur more, but I will receive less. Okay. So then question says that the penalty for non-performance of the contract is expected to be 0.25 million to 2,50,000. So friends, tell me in this case, do I need to, whether I want to deliver this goods to Namita? Answer is no. Why? Because I have to incur 5 lakh rupees of net loss. But if I will not deliver, then as per contract, I have to pay her 2,50,000. So cost of breaching the contract, cost of paying the penalty is 2.5 lakh. But cost of meeting the contract, continuing with the contract is 5 lakh rupees. So tell me, first of all, whether this contract is onerous? Answer is yes. And how much provision is required? Tell me how much provision is required. What is lower? Cost of meeting the contract or cost of breaching the contract? What is lower? What is lower? Cost of breaching the contract is lower. Cost of terminating the contract is lower. It is only 2,50,000. But if I'll meet the contract, it will become 5 lakh rupees of loss. So I need to create a provision for penalty, provision for liquidated damages of 2,50,000. Right? Clear? Question number 7. Marico has an obligation to restore environmental damage in the area surrounding its factory. They have an obligation to restore the environmental damage. Expert advice indicate that the restoration will be carried out in two distinct phases, right? First phase requiring expenditure of 20 lakhs to remove the contaminated soil from the area, and the second phase commencing 3 years later from the end of the first phase to replant the area with suitable trees and vegetation. So guys, this company has a legal obligation to clear the environment, right? And due to their chemical factory, the soil has been contaminated. So now they have engaged some expert to clean up the environment, right? To clean up this contamination. So the expert has advised that this cleanup will take place in two parts. The first part, we have to remove the contaminated soil. We have to put the fresh soil, right? This is the first part. And the second phase will start after 3 years, once first phase will over. And after 3 years, we will plant some trees so that this environment will be sustainable environment. This environment will be pure environment, right? So this cleanup will happen in two phases, phase 1, phase 2. And this phase 2 will happen after 3 years. So first of all, without giving any information, we can understood that the time value of the money is material. So this question talks about, and if you have damaged the environment today, so you have an obligation today, so you have to create a provision. So for the phase 1, the provision should be upfront, but for the phase 2, you have to create a provision on the basis of present value, right? The estimated cost of replanting is 335 lakh. So the first phase cost is 20 lakh, the second phase cost is 35 lakh. So what should be your provision? 20 lakh plus present value of 35 lakh, discounting over a period of 3 years. Marico uses a cost of capital before taxation, pre-tax, of 10% and the expenditure when incurred, right? So the company has to apply a pre-tax discount rate, which is 10% for discounting. Will attract tax relief of the company. So tax relief has been given, but you are not going to be distracted with this tax relief, because in Ind AS 36 or Ind AS 37 or in these standard, the discount rate should be pre-tax rate, right? Marico has not recognized any provision for such cost in the past, and today's date is 31st March 2002. So guys, this company has not created any provision, right? The first phase of the cleanup will commence in few months time and will be completed on 31st March 2003. So in the 31st March 2002 balance sheet, they have not created any provision, and the first phase will get over by 31st March 2003, and they have to incur a payment of 20 lakh rupees. Phase 2 will be paid 3 years later from the end of the first phase, and the phase 2 will be over by 31st March 2006. That is 3 years from the completion of the first phase. Calculate the amount to be provided at 31st March 2002 for the restoration cost. So 20 lakh plus present value of 35 lakh. What is the present value of 35 lakh? So 35 lakh has to be, so you 1.1, 0.909. Second year, 0.909 divided by 1.1, 0.826. Third year, 0.826 divided by 1.1, it will comes out at 0.749 or 75, right? So you have to create a provision for that. So let me look at the answer. Question number 7. The 20 lakh rupees is also, this 20 lakh rupees has to be incurred by 31st March 2003. So 1 year is there. So 10% discount factor is there. This 20 lakh is also be discounted. Okay, so this 20 lakh has to be discounted. And this 35 is also required to be discounted at 10%. Okay, because this 35 lakh will incur by 31st March 2006. So this 42 lakh 8,500 is a amount of provision which needs to be created. Okay, right? Clear? Is it clear, friends? Any doubt? So I have also discussed 3 questions from Institute study material, 3 important questions. So let me know if you have any doubt, any problem. Otherwise, I'll conclude the session after 5 minutes. Good, Megha. So Megha has confirmed that she has understood everything. Sairam is saying, yes, sir, it's clear. So friends, today we have discussed this entire thing. We have discussed the meaning of provision. We have discussed the recognition criteria of provision. We have discussed that the provision is something which is a present obligation as a past event where outflow is probable and outflow is measurable, right? And this past event is an obligating event which gives rise to a legal obligation or a constructive obligation, right? Then we have discussed the contingent liability. Contingent liability is a possible obligation arising out of past event, but the confirmation will happen. Confirmation will depend upon the future circumstances, right? Which is not within the control of the entity. Or it is a present obligation arising out of past event, but it is not a provision. Why? Either outflow is not probable or outflow is not measurable. What is a contingent asset? It is a possible asset arising out of past events, but which will confirmed upon occurrence or non-occurrence of some future events, right? The provision has to be measured on the basis of best estimate, right? And while calculating the best estimate, you have to apply the expected value approach, right? In case of future outflow, right? If the time value of the money is material, provision has to be recognized on the basis of present value of the future outflow, right? In case of future event, for example, a legislation is virtually certain to be enacted, so the provision from that legislation needs to be taken into consideration for creating a provision, right? The fourth one is, in case of expected disposal of assets, the gain from expected disposal of asset is not taken into consideration, is not getting reduced from the creation of a provision. Okay, so provision has to be reviewed at the end of every reporting period. If the provision is no longer required, it is going to be reversed, right? And if provision is not required, it is going to be reversed. Okay, one provision is not going to be recognized for the so one provision is not going to be used for the other kind of provision. So Namita, we are not taking a cumulative factor for 3 years because question says that this 35 lakh outflow will happen after 3 years from the completion of phase 1. We are assuming that this 35 lakh outflow will be at the end of the 3rd year from the completion of phase 1. Okay, so if the outflow is after 3 years from today, so how much money I need to invest today so that after 3 years it will become 35 lakh? So of course you need to consider present value factor at the end of 3rd year only. Jay is asking, when upfront no discounting provision made. When upfront no discounting provision made. So Jay, your question is not clear, but again let me explain this. So first of all, if there is a present obligation arising out of past event, you have to create a provision, right? For example, in case of a legal case, the lawyers are saying that whenever this judgment will come, judgment will not come in our favor, right? Then what could be the provision? So of course, there is a present obligation arising out of past event, you have to create a provision. But if judgment is likely to come in the next 3 months, and the outflow is likely to be happen at 10 lakh rupees, then this provision has to be created at 10 lakh rupees. But if judgment is likely to happen after 3 years or 4 years, in that case, this provision of 10 lakh rupees has to be created or recognized on a discounted basis, because you are not going to pay 10 lakh rupees within 1 year. You are going to pay 10 lakh rupees after 4 years. Okay. So after 4 years, if 10 lakh rupees payment is likely, so you have to see what is the present value of this 10 lakh rupees. As simple as that. For example, it comes out at 7 lakh rupees. So today, if you will invest or deposit 7 lakh rupees, by default it will become 10 lakh rupees by having some interest element, right? Thank you, Namita. Thank you for your feedback. So guys, thank you so much. I hope you have enjoyed the session. I hope you have understood these provisions, continued liability and continued asset in detail. There is no difference between IAS 37 and Ind AS 37. So students who are also opted for GFRS paper, so this IAS 37 has also been covered for them. Okay. So thank you guys. Stay healthy, stay happy. Bye-bye. Take care.